In this video, I'm going to analyse Diageo stock by giving my views on the business and whether I personally would buy shares of DGE right now. And if you enjoy the series, please drop me one of these to support it. Diageo produces, markets and also sells alcoholic beverages internationally, and it is headquartered in London. They have an extensive range of products/brands, ranging from the likes of Bailey's, Tanqueray, Captain Morgan, Smirnoff, and also the popular dark stout named Guinness. DGE is listed in the FTSE 100, has 27,800 employees, and a market capitalisation of £67 billion. I would consider Diageo to be in an oligopoly. This is because whilst they do have some strong brands, individually they do not have much marketing power compared to their competitors. While some consumers may have more of a loyalty to one brand or the other, there really isn't much differing them, and I would nearly say that it's in a near perfect competition in which there are no factors that would stop you from purchasing one product or the other. But effectively here we do have different tastes, flavours, and it really is down to personal preference. However, due to their wide range of products spanning many different industries in a very fragmented competitor landscape, we can tell that they have a very strong moat, and I also believe that the industry has fairly high barriers to entry, as at the moment there are only very few firms that dominate internationally, as opposed to many localised different breweries building up. Furthermore, I believe this to be a constantly evolving industry, as several decades ago it was largely built up of loads of small breweries which were serving the greater need, whereas nowadays, as I mentioned, it is a few firms that do dominate globally, although there are smaller brands, of course. I feel that this could change in the future and we will see more adaptations to this, but at the moment this is how it stands. And perhaps we could see more of a transition back after the pandemic as we realise that perhaps we are too globalised and become more reliant on our own local supplies, and we may see more local breweries pop up. I believe that Diageo's closest competitors are the likes of Bacardi and Pernod Ricard, which is a French brewery. When looking at the price to earnings ratio of Diageo, we can see that they are valued very highly. This tells me that because their PE is higher than that of the industry and the market, investors are more bullish on this company compared to their industry or the market. Furthermore, if we compare their market capitalisation to their net assets, or more commonly known as a price to book ratio, we can also see that they are trading at a multiple of 10 times, which is far more to the industry and the market. This could either tell us that they have a high debt load, or it means that investors simply are willing to pay more for less earnings in a share. In the last 5 years, Diageo has managed to grow their earnings annually by 2.2% each year on average. And it really shows how resilient the business is when we look at how much of an earnings negative trend we've seen in the last year or during the pandemic. And in the last year, they've lost 55.4% of their earnings, mainly due to the written off £1.4 billion as a one-off loss. And it is quite impressive to see that they have steadily and slowly increased their profit margins over this 5-year period, excluding the pandemic, which perhaps tells me that whilst their revenue increases, their profit margins can also scale with this, and in the future you may see, or over the longer term, you may see a much stronger company. We can also really see how strengthening their position is when looking at the return on assets, which is fairly weak, but then we see their return on equity, which is moderate, and their return on capital employed, which I think is quite impressive. Although their revenue growth has certainly left more to be desired, I believe it is very much understandable, and they have grown it at a fairly secure pace. This is because they are a mature business. It's unlikely that this £67 billion company is going to triple in valuation over the next year. However, what we can assume is that they're going to be around for the next 50, maybe 100 years, and they will be slowly but steadily growing, providing there are no huge scenarios which may negatively impact the business. And you can get a free share worth up to £100 when you sign up to Trading 212 using my link in the description down below, or using the promo code at the bottom left of the video. Do remember you will need to deposit at least £1 to be eligible for that share worth up to £100 on Trading 212. DGE has a dividend yield of 2.38%, typically paid in April and October each year. They have a fantastic dividend history. In the last 20 years, they've managed to grow it every single year. Although it's not the fastest growth stock in the FTSE 100, over the last 10 years they've managed to grow their dividend by a compound annual growth rate of 6.25%, which more than triples the Bank of England's target for inflation, meaning that this is certainly a good growth rate and quite secure. Furthermore, whilst they do have a perhaps more scary or riskier payout ratio of nearly 117%, meaning that they're actually paying more than they earn, this is largely due to that one-off loss and likely negative impacted by the pandemic. However, what we can assume is that as this is a mature business, that typically their payout ratio is going to be on the higher side, as it's more rewarding for shareholders if they invest this money back into a dividend rather than back into the business. When looking at the balance sheet of Diageo, we can see that they have a good but not great balance sheet. This is because whilst their short-term assets do outweigh their short-term liabilities, they don't outweigh their long-term liabilities. Furthermore, when we look at their debt loads, they are quite high. At the moment, they have a debt-to-equity ratio of 199%, which has steadily increased over the last 5 years in a combination of increasing the overall debt and decreasing levels of equity. But when we look at their cash position, which is £3.4 billion, it certainly is showing that they are able to continue paying this dividend even if they have a negative earnings trend for an extended period of time. However, providing they do reverse this negative earnings trend and they once more increase their free cash flows, it's very likely that they will be a stable, reliable and defensive dividend payer, and hopefully they can drop that debt load down in the future. And at that point, I could certainly see this stock becoming back into that more defensive position that you would hold in your portfolio. But with that debt to equity ratio being so high, I do believe there is an element of risk in this stock that perhaps wasn't visible in the last few years. In the future, I still think they have a lot of growth. This could be organically by building upon their current product line, marketing them out more and getting more market share in their respective industries, or this could be from inorganic growth such as acquiring other breweries and adding it to their ever-expanding portfolios of different spirits and ales. Also, I have a feeling that over the longer term that people may transition into purchasing more alcohol online. At the moment, typically you would go into a local supermarket, independent retailer, or perhaps go to your local pub. And at the moment that means that online retailing is one of their lowest revenue streams. However, as time goes on and technology increases, I could legitimately see this trend happening. And if we think about this, this could mean that there is no middleman, meaning that Diageo's profit margins could increase further, allowing for more earnings growth. If you'd have owned shares of DGE in the last 5 years, you would have gotten returns of 80% with dividends reinvested, which I think is quite impressive as it beats both the market and the industry. I think Diageo is a slightly more risky investment in which you're trading a lower dividend income for a little bit more growth potential. And I personally think this is an investment or holding that anyone could hold in their portfolios. This is because if you're in retirement, that dividend growth of 6.25% combined with that fantastic history of reliable payments, knowing that in a recession they will still be paying a dividend, could provide that much needed security for a pensioner. But on the other hand, maybe someone at a younger age could use this more as a hedge. If they have a more defensive position in the portfolio, at least they could then have that security in the back of their mind, knowing that they have a lower element of risk, whilst they may be perhaps chasing higher growth stocks. In the past, I had owned shares of Diageo, although I did sell them out, and I really like the company and the feeling of owning all these different brands and how much of a dominance or moat that they truly have. However, I did sell this position, and that's because I don't think it had a place in my portfolio, simply because I only hold 6 stocks, and these stocks I believe are in more resilient industries than the likes of alcohol. And I feel that these companies that I own have more growth potential at maybe the expense of a lower dividend yield compared to Diageo. If you're interested in seeing all of the stocks I hold, and it's updated weekly, then click the card at the top right of the video, which will link you to my portfolio updates. Thank you for watching. I'm Osborne Foreman. Have a great weekend.